Imagine a customer wants goods today, but the cash will come later. You still want the sale, but you also want proof that payment will arrive. That is where a bill of exchange steps in. A bill of exchange is a formal, written document used in accounting and international trade. It is an unconditional order in writing, signed by the drawer, requiring another person to pay a certain sum, at a fixed future time, or on demand, to a specified person. In simple terms, it is a legal pay-me-later note. There are three key parties. The drawer creates the bill, usually the seller or creditor. The drawee accepts the bill and owes the money, usually the buyer or debtor. The payee receives the money, and often the drawer and payee are the same person. Simple idea. Powerful tool. So why do businesses use bills of exchange? First, they are legal evidence of debt. If the buyer defaults, the seller has written proof. Second, they support short-term financing through discounting. If cash is needed before maturity, the bill can be taken to a bank, which pays the seller early and deducts a discounting charge. Third, they can be endorsed. That means the bill can be transferred to another party, often a creditor, to settle a debt. Fourth, they help in international trade by building trust across borders. Now let's move from concept to accounting. The drawer treats the bill as a bill's receivable asset. The drawee treats it as a bill's payable liability. That difference is the heart of the journal entries. First scenario, credit sale and acceptance. The seller records the credit sale by debiting debtors and crediting sales. When the bill is accepted, the drawer debits bills receivable and credits debtors. On the buyer's side, the purchase is debited and creditor is credited. Then, when the bill is accepted, the drawee debits creditor and credits bills payable. One sale, two books. Two very different effects. Second scenario. The bill is kept until maturity and honored. Here, the drawer receives cash or bank and credits bills receivable. The drawee debits bills payable and credits cash or bank. The obligation is settled cleanly, exactly as promised. But here's where it gets interesting. A bill does not always wait patiently until maturity. Third scenario, discounting with a bank. If the drawer needs cash early, the bill can be sold to the bank. The drawer debits bank for the amount received and debits discounting charges for the fee, then credits bills receivable. On the discount date, the drawee makes no entry, because the maturity obligation still exists. At maturity, the bank collects from the buyer, so the drawee debits bills payable and credits cash or bank. Fourth scenario, endorsement to a creditor. If the drawer owes another supplier, the bill can be transferred to that creditor. The drawer debits creditor and credits bills receivable. On the maturity date, the drawee still pays the holder, so the drawee debits bills payable and credits cash or bank. The bill has moved, but the obligation remains. Now for the risk every learner should remember: dishonor. If the maturity date arrives and the bill is not paid, the bill is dishonored. The previous entries are reversed so the debtor is recognized again. The drawer debits debtors and credits bills receivable. The drawee debits bills payable and credits creditor. If noting charges are paid, those are recorded as an expense by the drawee, because the default is their fault. And that is the full life cycle. From credit sale, to acceptance, to maturity, to discounting, to endorsement, and even dishonor. One bill keeps changing form while the accounting stays precise. It protects cash flow, documents debt, and keeps business moving smoothly. Like, subscribe, and comment if you want a full numerical example.